Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So you might have noticed a different format here, trying something new, different. Let me know what you guys think in the comment section below. Maybe I'll do more of this, maybe not. I don't know. But curious of your thoughts if you like something like a format, webinar kind of format like this. It's a little bit easier for me to also share my screen and show a couple of things. So yeah, let's just test it out and see. So I want to talk about something very interesting. Few things. There's an article also I'm going to share with you that comes out from Bloomberg, but I want to talk about a idea, maybe a concept that's not really talked about so much for 2024, and it's the risk of inflation being very sticky for this year, right? It's the risk of inflation even creeping up a little bit higher this year versus, the complete collapse of inflation to the 2% target. Now, you might be seeing in, let's say, certain inflation metrics, CPI and whatnot, coming down to closer to the 2% target, but not there exactly. And you might think that, okay, the fact that we have come down quite a bit, that means the Fed can now, ease and they can move away from the tightening conditions. But that's not really true because they have to hit their 2% target. And as we've learned and as we've known from before, the Fed during actually pre-COVID, they changed the way they looked at inflation. They actually introduced the average inflation target AIT, which is basically stating that inflation, they need to get an average inflation number either above or below the 2% level in order to achieve a certain average, a certain metric. So what that basically means, let me clarify again, is that if they want to get 2% target, it would have to take a set number, of series of numbers in order to hit the 2%. So if, inflation is, the average inflation is below 2%, they would want the inflation numbers to be above 2% for multiple period of time. So that would mean, let's say, 4%, 5%, 3, then 1, then, 1.5, and then kind of adding all those together to get the average inflation target to 2%. So same thing here, right? And this is something that no one, not that I see out there, uh, no one's really talking about. It seems like everyone forgot that since COVID, right? Since 2019, when that was basically introduced. So it's very interesting that, when that happened, then we had COVID. And with the AIT, the idea was to have inflation overshoot to get the inflation level, the average number above. Now, what happened with COVID, with supply chain shocks, we got inflation to really, really move up high. And that's where you're seeing, prices are have moved up quite significantly. Now, when you look at, for example, let's say the current inflation level where it is right now, and the fact that it's not at the 2% level, you could kind of speculate and expect also that you would want to see multiple reports of the number going below 2% to get the average to the 2%, and then the Fed doing something about it, right? So if that's the case, and we're continuing on this AIT trajectory, right? Then that would mean that these rate cuts that the markets are expecting, right? The markets are basically pricing in or expecting 6 to 7 rate cuts this year in 2024, and that to start in March of this year. And the Fed has penciled in basically 3 rate cuts in its projections and can definitely change. And we heard from the Fed minutes as well that, they pushed back on the idea of rate cuts happening early in March of this year. And they more talked about the consensus view is more of that you could see rate cuts more to the end of 2024. So if that's the case, then that would basically mean that if the economy is doing fine, if growth is doing fine, GDP is doing fine, that would mean also inflation, depending on also certain circumstances with the supply chain factors, would be, sticky, because wages would remain sticky, right? Companies wouldn't be all of a sudden start lowering their wages, unless there is something that ends up being really bad in the economy. But if we're talking about the soft landing narrative that everyone's talking about, then you can expect that, the wages to stay where they are, certain areas of the economy, creating the stickiness in the inflation, which would keep the inflation CPI where it is, and which would also not move the needle for the average inflation target, the AIT. Now, the biggest risk for this year is basically inflation staying where it is, um, and certain factors like supply chain being disrupted again, that causes inflation to be sticky, and the growth starting to deteriorate, jobs starting to get worse off, and the Fed is too late, right? The central banks are too late. They don't move. And I think that's the likely scenario that might happen maybe closer to the end of the year, where you will see the data start to deteriorate further and further, but the central banks don't move, too early, or they start cutting rates, but it's not enough to withstand the blows in the economy. It would have to take much more, not just simply any kind of rate cuts, even 2 rate cuts, 3 rate cuts, 6 rate cuts. I don't think that would be enough. You would have to start bringing back QE, the pumping, the printing of money to start saving the economy. And I think that, with that risk, where inflation is staying sticky, they got to hit their mandate, they got to hit their goal. They might be cutting rates, but still it's not enough, and the risk that inflation could be even maybe creeping up a bit because of supply chain constraints, because of maybe some sort of geopolitical tensions, war, etc., that could cause the central banks to hold and not do much, or not ease as what the markets are would be expecting, right? You see the expectation from the markets already about 6, 7 rate cuts. If it's not delivered, if that easing is not delivered as what the markets are anticipating, you might get a tantrum in the markets, you might get some panic, right? So I think those are some of the biggest risks out there, is that this narrative of this easing, the risks of also supply chain getting further disrupted, possibly also oil prices moving higher. These are things to keep in mind when it comes to the future data points, and when it comes to also the rate cuts, the monetary policy, the QE, QT, etc., etc. Now, a lot of people will argue, supply chain was not the reason why we saw inflation get exacerbated, and I truly disagree with that, right? Somewhat, I should say. Yeah, yes, we printed a lot of money. That also contributed to higher inflation, but so did we after the great financial crisis. After that, a lot of money was printed as well, yet inflation didn't skyrocket, right? So you had COVID that created that brought in a lot of money printing, and we've seen money printing in the past, but it did not create crazy amount of inflation. What made COVID different versus the past recessions or past money printing was the supply chain disruptions. You got to remember one thing. We lived in a decade long of China exporting deflation, disinflation to the West. You got cheap products coming in. As soon as that stopped, as soon as the supply chain disruptions got disrupted, right? Supply chain got disrupted, right? As soon as China started to close their borders, tighten things, as soon as the shipping costs started to go up higher, and etc., the world started shutting down, it fed into everything you could think about: grocery prices, food, shelter, lumber, etc. Everything started to go up. I understand there's other factors as well, higher interest rates feeding into the rental prices, the shelter component, money printing. I totally get that. I'm not disagreeing with anyone on that idea. But the supply chain is the most important thing, because even with the Fed doing all the tightening that it can do, if the supply chain disruptions are not fixed, you know, then you could get inflation to creep back up again, and you could have factors where prices still remain elevated because of this new world that we are in, right? The less of the dependent on China, the less of the just in time delivery, right, that we lived in the past decade, the cheap labor, the products and whatnot that we were used to. We have completely seen that shift. Until that normalizes, then you can be confident that inflation, um, will stay low. Now, there's an argument to be made also that if this recession ends up being very bad, if the downturn is bad, and you get a deflationary recession, that could start to open up things, right? That might bring down the cost of shipping, the cost of many things. Many countries will start to come back to the trading desk, the coming back to other countries to try to cooperate to make things easier for the world globally, right? We've heard also China starting to say things that we need to cooperate more, cooperate better with the West, with everyone. Everyone's feeling the tensions, especially China as well. So it may take that, right? It may take a global deflationary, ugly, hard landing recession in order to then normalize things and bring back everything to normal, maybe, right? So let's go over this article here, and this basically, I'm going to share my screen here, but it basically goes over something what I'm talking about, and it goes over the idea of the risk of shipping costs, right? This is what's going to feed into that higher food, the higher cost when it comes to grocery bills and etc., which is important. These is essential items out there. Food at home, food at the restaurant, right? These certain commodities, oil, wheat, grains, all of these things, right? So shipping is very, very important. Transportation cost is very, very important, right? The shipping industry is the lifeblood of many economies out there when it comes to delivering your food, your Amazon packages, FedEx, UPS, Maersk. All these companies are very, very important. So this article here comes out from Bloomberg. I'll link the article in the description for you so you could read up on it. Basically says spot container shipping rates soar 173% on Red Sea diversions. So it starts off saying short-term rates for container shipping between Asia, Europe, and US are climbing on reduced capacity caused by ongoing threats to cargo vessels in the Red Sea. The spot rate for shipping goods in 40-foot container from Asia to Northern Europe now tops $4,000, which is a 173% jump from just before the diversion started in mid-December. Freightos.com, hope I'm saying this word right, a cargo booking and payment platform said late Wednesday, right? So this website here, it's a booking cargo booking website. It basically experienced 173% increase, a jump, in its shipping from Asia to Northern Europe just before all these diversions started. And it basically started in the mid-December, right? Mid-December. The cost for goods from Asia to Mediterranean increased to $5,175. That some carriers have announced prices above $6,000 for the route starting mid-January. Rates from Asia to northern east coast have risen 55%, right, to $3,900 for a 40-foot container. Services from Asia, Northern Europe, and Mediterranean both cost more than twice their levels in January 2019, but are still well below the peaks, right? So still below the peaks of January 2019, but way well above there. And if we scroll down also in this article here, it talks about the oil tankers. The impact goes beyond than the container sector. Oil tanker markets have also seen some gains. Shipbroker, Bramier, again, I probably said it wrong, wrote in a research report, mostly for vessels hauling refined fuels like gasoline and diesel. Earnings for ships hauling refined fuels from the Mediterranean to Japan via the canal have climbed from about $8,000 a day to early December to $26,000 this week, right? Any route involving the Red Sea is red hot. So this is very important, right? The Red Sea is an important route for shipping as well. And if you got big companies like Maersk, you got oil companies out there, oil tankers out there that are being disrupted, it will definitely cause some issues. It'll definitely cause issues in the economy. It'll cause issues when it comes to the next inflation report that we see, the higher costs that we see, right? And this is going to be the key for 2024 is to watch shipping rates, watch, the supply chain disruptions. Although sure, there's a demand component that as the economy weakens, demand weakens, you might see things get, prices start to diminish and go lower. But what kind of weakness in demand will need to be taken, or will we need to see in order for these shipping rates, for prices to come down? And if we look at history, whenever there is a recession and a hard landing, we tend to see those prices come down. We tend to see deflation, which then helps the Fed and many central banks achieve their 2% target. So the biggest risk that I see for 2024 is if the economy is still fine, we're still in soft landing mode, if the economy is still doing well, and the data points, the growth is still strong, and prices are still elevated, there's still somewhat demand, it would create inflation to be sticky because you don't have that demand crunch in the economy dragging that price down. And it would require that, which would mean the central banks would remain tight for some time. The rate cut expectations, right? The markets are expecting a lot of rate cuts. It may not be delivered, which may cause the panic. Don't know when, right? We can't really pinpoint when exactly, but I think this is one of the big risks for 2024 to watch out for. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.